when you talk about global macro, the only thing Indians understand about global macro is वो Fed rate change होने वाला है, Powell is coming and saying something. 80% of the people don't understand this as well, right?
Globally, markets have fallen when there was the war, COVID, and now obviously what's happening in the Middle East.
The domestic investors have become a large part of the Indian market, and FIIs are starting to lose their relevance. What was happening in global macro 10 years back was far more significant than what it is today.
Whenever a currency collapses globally anywhere, the US dollar starts to move there. If you go to Argentina today, you can actually go and pay someone US dollar and you will be able to do a transaction.
Typically, retail guy would read the headlines, okay, auto sales are at their highest, so you go ahead and buy auto, which is actually the worst time because...
Hi, my name is Shashank Uduppa and welcome to HDFC Sky Presents Make Money Matter. Now our podcast has got financial experts who will talk about insightful information about different industries in the stock market, and after listening to this podcast, you will be the smartest guy in any room. Now you won't find any podcast like this which has so much depth of information, and this podcast will actually make you one of the most informed investor. Hey guys, so welcome to an episode of Make Money Matter today with HDFC Sky, and in this episode we are going to talk about global macro. Now what is global macro? It's basically understanding different countries and different economies of every country and see how it actually affects the Indian economy and your portfolio as well. And to understand all of this, I have got two experts with me today, Mr. Varun and Mr. Unmesh. So first, before we start, I want you guys to give a very quick small intro about yourselves.
Yeah, hi, I am Varun Lochab. I've been in equities for almost 21 years now. So I did my MBA in finance from IIM Calcutta. Prior to that, I've done my engineering from Delhi and then worked in the IT sector. And in the 20 years in equity markets, my core area of expertise is consumers. But I've been heading the overall research. I worked at Franklin Templeton and Fidelity and Jefferies before this and looked at multiple sectors. So.
Okay, wonderful. Mr. Unmesh?
Yeah, another engineer MBA.
Yeah.
So I started my career with Standard Chartered actually selling car loans. Post which I entered markets, worked at JP Morgan in New York and then in India. Worked at Macquarie. I was an analyst for 9 years across consumer and real estate, where actually, when Varun was at Fidelity, I used to service him. He was a client of mine.
So we go a long way.
Go back
That
a
was in
long way.
India or US?
In India.
In
India. This was
in India.
2006-07.
Okay.
Yeah. And then moved over to sales at Macquarie itself. So across, in the last 20 years, I've worked at Merrill Lynch, JP Morgan, Macquarie, and now at HDFC for the last 7 years. Used to run capital markets. So after being a research analyst, salesperson, and equity capital markets guy, I basically run the institutional equities business.
Wow, this is like a dream of all IBs, I think. I mean, being in these names are like where people actually want to go. So I want to ask you guys this question, right? Because, people look at global investing in India, not too much, right? For example, I'm only so concerned about my equity, my portfolio, my sector, and a lot of people are also doing very short-term bets in today's market, right? But when you talk about global macro, the only thing Indians understand about global macro is wo Fed rate change hone wala hai, Powell is coming and saying something. I think 80% of the people don't understand this as well, right? Now, my question to you is, why is it so important for us to look at any global market?
If you go back in history, there was a reason why, at least institutional investors have been following what's happening in the global macro for a very long time. Multiple reasons. One, a lot of the institutions itself are from those developed economies. So what's happening in the home market, gives them an outlook of whether to go for emerging markets or not.
Okay.
Secondly, all said and done, US is still the mothership. Like it's the largest market. By far it dictates how a lot of the other markets do. The sentiment gets driven from there.
Why is that though? Is it because of the cash outflow?
Because
that
of
comes?
just the sheer size of the market. Like,
Okay.
India is a $5 trillion, sort of market now after doing so well, whereas US is a $50 trillion market.
Okay.
So it's 10 times the size. So the amount of money which can come in and can go out of a country just because of how US feels about that country can move things a lot. But over a period of time in the last 8 to 10 years, and especially in the last 5 years, the domestic investors have become a large part of the Indian market. And FIIs are starting to lose their relevance. So from that perspective, maybe what was happening in global macro 10 years back was far more significant than what it is today. Because now the impact of foreign investors into India is much less than what it used to be.
Understood.
But at the same time, they are still, a reasonably important part of the market. They own 15% of the market even today. So that's why it's important to keep a tab on what's happening in global macro, more from the perspective of whether the money will be coming in to India because of the developments outside, or money will be moving out from India. So it just gives you a sense of the liquidity. And second is global growth. That if the global economy is doing better, then obviously the prospects for some of the Indian companies which are export-oriented businesses tends to get better. So from these two perspectives, one, liquidity and flows, and second is the global growth. You need to keep a tab on what's happening in global markets.
Okay. Now, Unmesh, what is your take on this? Because as he mentioned that you need to track the liquidity, but how does a normal person understand when the cycle is changing, right? When the cycle of liquidity is increasing or when it's decreasing? So how do I understand that?
No, so we'll break it down into two parts like he did.
Yeah.
So, as he said, US is the mothership. Now, the reason why US is the mothership is because it basically underwrites liquidity globally. It's the, it's the one on which 2/3 of the trade globally is, the US dollar is the one on which 2/3 of the global trade is determined by. And on top of that, they also underwrite security globally.
Okay.
So if you go back to the 60s and 70s, basically with the breakdown of the Bretton Woods system, effectively the US currency became the underwriter of everything globally. So, to put it into perspective, whenever a currency collapses globally anywhere, the US dollar starts to move there. If you go to Argentina today, you can actually go and pay someone US dollar and you will be able to do a transaction.
It's like a gold standard.
It's a global reserve currency.
It's a global reserve currency.
Yeah.
What also happens is that the linkage between US and India, for example, which is how, probably how Indian investors would think, is at two levels. The first is what happens to the economy, and the other is what happens to markets, which is what he was talking about.
Correct.
If you look at the impact on the economy, the way in which interest rates flow globally is the fact that the size of the the financial market as a percentage of GDP in the last 25, 30 years since we started our career. At that point in time, I remember we are from the same batch. So what used to happen was that it was almost the same. If you put the size of the derivatives contracts on that, the size of the financial market today is 4 to 5 times that of GDP.
Wow.
Okay. So what that means is that the tail wags the dog. The money is determining the economic outcome. So the relevance of basically whatever the US does with monetary policy goes down straight to the economy. Okay, so allow me to elaborate. What will happen is that, and I'm not talking about liquidity here, I'm talking about pure economics. So if the interest rates in the US go up, okay, naturally money will try to find the highest return. So money will want to move to US debt. So what ends up happening is that all the other central banks, to ensure that money is not moving out of their country and creating volatility within the currency, will try to move in tandem. So if you see, there is an expectation there will be a rate cut in the US in September.
Yeah, can you explain this in more simple terms, like for someone who has no idea what a rate cut is, right? When Powell comes and says, "मैं rate cut करने वाला हूँ या बढ़ाने वाला हूँ," how does that affect a lot of things in US? Let's only talk about US perspective.
Yeah,
how does that affect?
Look, let me not go into serious technicality.
Yeah, in a very simple.
But
short.
what happens is that the Federal Reserve is different from the government. It's an independent agency. They have a simple mandate to ensure that basically inflation doesn't go out of control. Inflation and rates have an inverse correlation. Whenever rates go up, inflation comes down because the economy slows down because of higher rates.
Can't spend so much.
Yeah, you can't spend as much. The businesses who are going to invest will invest less because the cost of money goes up. Now, at this point in time, what's happened is that global rates have, US rates have gone to a point where if you look at the data for the last 1 year, slowly the very high inflation, which had reached 7%, has now started to come back to their target of 2%. We are at 3 right now, so the trajectory is in that direction. And recently, unemployment rates have started to go up, which is the mandate of the Federal Reserve.
Are they linked?
In a sense, yes, while with a lag. Because when rates go up, businesses invest less.
Correct.
Less jobs get created. So, of course, it's not, I wish life was that simple, but it's not. But it's something like that. So what happens is whenever rates go up, less jobs get created. As a result of which, what happens is that they start cutting rates at some point in time when it feels like the trajectory is in the right direction. So as of right now, the inflation has come down to 3% and moving from 7. So it's in the direction of going to 2, which is the target of the US Fed.
Okay.
And at the same point in time, the unemployment has gone above, has come to around 4% or so. There's been a small spike. What it is effectively saying is that the economy is weakening and the inflation is coming off. At this point in time, it seems like we are at the peak of the cycle, and which is why if you see all the commentary from the Fed, is that rates will come down.
Yes.
Now, how does it affect us? If the rates go down, relatively the rates there would have fallen, but not in India, let's say. I'm just taking two countries, assuming it's a two-country system. Now, here the rates are down and here rates are up. Okay, what will happen is the money will leave and go to the higher rate. That creates volatility in the currency because that will have to be converted into Indian rupees. Now, what happens is that as a result of that, the currency will appreciate, which harms what he was talking about, the export sector.
Correct.
Okay. And so what happens is that all central banks, because the money flows so freely, will try to ensure that the difference in rates between them is broadly consistent over the cycle.
Okay, so if they cut rates, then usually our RBI also will.
With some lag.
With some lag.
To
they
give
will
you an
also-
example, the Bank of England, the European Bank have already cut rates, even Australia.
Okay.
Because they know the US is going to cut rates in a
Okay.
sense. Of course, they have their own domestic drivers, but broadly, this is what they're trying to do.
Okay.
Which also kind of implies that if the US cuts rates, then so will we.
Okay, so is it, again, to simplify the US concept, is it understood now because, let's say, the inflation is coming down to their target, so they're okay. Now they're going to cut rates. Usually when you cut rates, as you said, now the economy will start picking back up because now the cost of borrowing is going down, so people will take money. Unemployment will come down because now, again, so will we again go back into liquidity? Will liquidity again come into the market, which will again might spike inflation going up again for them?
So see, lower interest rates typically mean that money is available more freely, right?
Yes.
And people are willing to borrow more.
Yes.
And therefore the economic activity starts to pick up. And therefore the growth picks up, and then again inflation will pick up, and so it's a sort of a cycle, right? These are typical economic cycle. So all banks, if you look at all central banks, their main mandate is to keep inflation under check and unemployment, so maintain this growth and inflation balance. But the primary mandate is inflation. And therefore, 2021-22, when inflation really shot through the roof, all central banks increased the rate. And coming back to your question, what is this Fed rate? These are the benchmark rates. Like, in India, you would have heard repo, reverse repo.
Correct.
So it's basically the rate which central bank, so is the benchmark rate at which the central bank is willing to lend to the other banks. And then every other product, financial product, which is linked to interest rates would get priced higher than that. So this is, in a way, effectively raising the bar or lowering the bar, right? So interest rates in the entire economy will move up and down basis either the Fed reserve rate going up or down, or say repo rate going up and down. So I think now the point which Unmesh was saying is that we are entering a phase where probably the worst of the inflation is behind globally as well as India. If you see across all countries, interest rates are trending down.
Okay.
And, when I say like inflation is already trended down, and therefore interest rates are now starting to, the expectation is that they will moderate going forward.
So if I had to give an example, let me know if this is correct, right? So during COVID, when things were bad, the interest rates were low, right? So that means all the interest rates were low, so there was a liquidity.
They were lowered by the banks.
By the banks to fuel economic activity, right? Even US and India did that. It happened, and then the consequence of that was, let's say, inflation, which went up a lot. And then now to curb that inflation, they took it up back to, let's say, 6 to 8% or 8.5%. And now everything's come back to normal. We didn't get affected so much. But they tried to aggressively increase the rates. That was what was happening. Every quarter they were increasing it. And now it has come to a point where they're saying, okay, everything is stabilized. Now we can slowly go down, but not as fast as what we did during COVID.
Correct.
Is that correct?
So I think only thing is like the inflation went up very sharply in that period, not just because of lower interest rate, but because of the supply chain disruptions which were caused due to COVID.
Correct.
So all, materials, and then Russia-Ukraine war further disrupted the supply chains, and Russia is a big exporter of a lot of commodities. So that caused the second spike in commodities globally when the Russia-Ukraine.
So this is very fascinating.
One more thing though, interestingly. So in the West, probably the spike was even sharper for one more reason. One is India is actually less linked to the global economy. So when he says that only 25-30% of the index, so as to speak, is linked to the external sector. This is relatively lower than other countries. The other is that in the US, because they had a bit more fiscal space to play with, which India did not have at the time of COVID, what happened was that the government, now this is not the central bank, now I'm shifting focus to the government. What the government did was that they had started paying people.
The checks that they gave.
The checks that they were giving.
Oh, okay.
So there were 3 levels, but we'll ignore that. But basically what they did was to support poor people during COVID, they were actually putting money into people's accounts, which kind of tailed off only after a couple of years. So you could raise rates as much as you want, but when actual money hits people's bank's account, they're going to spend it. And that money actually also led to a spike in inflation, which was much more than what happened in India. Because in India, we had actually not distributed as much money. Pretty much the only big fiscal move we had made was actually guaranteeing food. But other than that, actually money hitting the account was not so much at that point in time. So they actually suffered from that for a while as well.
So they had a demand spike
Very
coupled
interesting.
with the supply side issues. So it caused like a havoc out there.
That's why they were so, yeah.
You know, those economies are not used to 6-7% inflation the way, you know, we are used to in India. So
Yeah.
for them, the delta was huge, like, you know,
Yeah.
moving from 0 to 1% inflation levels to suddenly 10%.
Understood.
Whereas in India, the inflation went up from 5% to 8%, and we have been used to 7-8% even, you know, prior to COVID.
This is okay. This is very interesting. Now I have one more off take on this topic itself, right? We saw that the interest rates went down, and after COVID, we eventually went up, right? And usually, what happens is the spending goes down, as you said. But in India, we still had a rally going on at that point, right? I mean, we never stopped the rally after 2020. We did have the small dips due to war and external factors, but India as a thing did not play out. Why is that? Is it because of the emerging market tag? Is, as you said, people run behind rate of return? Is it because of that?
No,
What was the
actually,
reason?
it's a very long story.
Like in
So-
short.
Short version.
So I think, you know, what happened in case of India was that India was coming out of a long period of, say, from 2010 to 20. If you see, Indian GDP growth was still okay at 6 to 7%, but
Yeah.
if you look at the corporate earnings were not doing so well because the bank had NPA issues right from 2015 to 20, right? Corporates had a balance sheet issue after the IL&F NFS crisis and even prior to that. So corporate balance sheets were not in great shape, bank balance sheets were not in great shape. So in India, the capex spending and the whole infra and investment side was not booming for almost 10 years. The previous cycle happened in 2003 to 2010 period. And post that, the excesses of that was leading to, you know, slowdown in most of the economy facing sectors from 2010 to 20. And then post 2020, you know, we saw that after the COVID, after the opening up, demand was fairly strong. Banks had really actually cleaned up their balance sheets till then.
With that bad bank
Government,
and-
yeah. And government came up with, government didn't do anything to spike the demand artificially in the short term. In fact, they came up with more structural policies like PLI and all, which will again, you know, kind of increase the propensity of businesses to go and spend and, you know, put up capex for future this thing. So India entered actually a period where the earning growth for Indian corporates really picked up in the last 5 years. So the reason why markets have done so well, one, obviously valuations have gone slightly ahead of fundamentals, but fundamentals have improved significantly. Just to give you a context, from 2014 to 2020, the corporate earnings were growing at 5 to 6% CAGR. And then from 2020 to now, in the last 4 to 5 years, they have grown at 17-18% CAGR.
17-18%.
Because banks improved their profitability significantly. A lot of, you know, power sector, a lot of sectors which were beaten down and out of flavor, they improved their performance and profitability. So that's why Indian market has seen a fairly secular bull run. And
Understood.
the impact of interest rates, as I said, anyway, was less in India.
And we did see a lot of FIs also coming in.
We didn't see that much increase in interest rates in India or inflation, which would curb the economic activity to that extent, as we saw in the West.
No, in fact, on the liquidity is actually the other way around. What ended up happening was that the FPI ownership in the Indian equities actually peaked in 17-18.
So FPIs, foreign portfolio investors.
Foreign portfolio
These are the
investors.
They're
foreign
also
these
called
are-
as foreign institutional
investors.
FIIs or FPIs.
FPI
Got
is
it.
now more or less the same thing. It's just a technical difference. So what happened was that it actually peaked at 23%. So all of corporate India, if you look at, assume all stocks listed and put all the ownership together, at the peak, FPI ownership was 23%. At that point in time, the Indian mutual funds and domestic, not non-retail domestic, as in institutional investors, used to own 10-12%.
When was this approximately?
2018, if I'm not
20,
mistaken.
before
So,
before the COVID.
2017.
yeah, so this is basically what happened was that the big surge coincidentally happened around the time of demonetization. That's when if you remember, if you look at the chart of SIP growth, that's basically when it started to pick up. So Indian retail investors started to get interested in investing in market through the mutual fund route. That was the first round of the big inclusion story of financial participation. That thing has kind of culminated to a point where, as of last quarter, Indian institutions own more in Indian Inc. as compared to the foreign portfolio investors. So actually what's happened is that in 2018 till now, FPIs have actually continuously been selling. As in, I'm talking at an aggregate level.
Yeah.
Maybe there are a few months here and there, but they have generally been selling and the domestic has been buying. Now, this level of phenomenon of movement of ownership, at least in my career, I've seen only one more example of this, which was in Hong Kong, China back in 2004, 5, 6, 7, 8, where the domestic investor suddenly realizes that this is a great way to invest your money. It goes away from, there's a generation change, there are trigger events like demonetization, which brings money into the formal.
We had the fintech boom as well.
And then the fintech boom, which kind of, with COVID, people sitting at home and trading. And at the same point in time, this whole participation story played out. Now, what's actually happened as a result of that is that this is a secular flow which is chasing that much amount of stock. And so, actually, if you think about it, we've been quite single line, left, bottom, right, top on everything. Globally, markets have fallen when there was the war, because there have been three big events, right? COVID, then there was the Ukraine war, and now obviously what's happening in the Middle East. And India also got lucky at that point in time, because what has happened is that because global demand for oil has not been very bad, there has been no major negative trigger on the external front. So you put it all together. What am I saying is that the pace of selling of the FPIs kind of gradually went. There was no major trigger to sell in a big way. And whatever selling was coming was getting absorbed by the domestic.
And will this continue?
So yeah, that's the $1 trillion question. As of right now, I feel it has more legs.
This is very interesting, see, because I look at things from a retail standpoint, like a retail investor, right? Obviously, you guys are from the fund, I'm from the retail side. The way you look at things is very different from how I look at things, right? Now, I want to ask one question to you on that concept. Now, we know that interest rates change hota rehta hai, right? Whether it is cuts or hikes. Now, we are going towards a cut market, right? How does it affect, which sectors does it affect in India? Because me as a retail guy, I want to see that am I invested in the right sectors or am I invested in the wrong sectors? So first I want to address what are the sectors that automatically become favorable and why? And what are the sectors that are not favorable and why? What is the consequence of this? Anyone can take this.
The delta in interest rates impacts every corporate and the flow at multiple levels. Basically, it's a accumulation of all the stock prices. Now, what impacts the stock price itself? The first is that at the bottom level, if rates come down, then the ability to borrow money cheaper leads to a creation of demand.
Okay, so he'll borrow money to expand his business,
yeah, so they can buy a house. No, so it's at two levels. The individual at the end will basically be able to buy a house or a car or consumer durable or something like that. So that actually incrementally incentivizes that. And as more and more happens, at every 25 bips, there will be someone standing waiting for that opportunity to take money.
Wonderful. Okay.
So every time the rate goes down, there is someone new who turns up and says, I'm buying. So that's the first. Then comes to the corporate level. Now the corporate sees this demand grow and the cost of money has fallen. So is incentivized to do capex. Let me set up a plant because first the demand is coming through and the cost of money has become cheaper. Now, why is that important is because every entrepreneur will look at the capital structure of setting up any capex and will have some element of debt in it. So when the cost of money falls, the ability to do capex increases. So that's your second point. And at the third level is basically how do you value this? Because you look at, so what is a stock price? Absolutely fundamental theoretically is that it's the present value of all the cash flows.
Correct.
Okay. So whatever, whenever someone buys something or does capex in something, they look at the cash flows coming from that and then they value it as what it means today. Interest rates have a very big role to play as to how that valuation is done. Because to very simplistically, just bringing down to absolute bare minimum. Today, if the cost of deposits is 7% and it goes down to 5%, the propensity of that person instead to not save but spend or put in equity versus debt changes.
That's what's happening right now.
That will happen, kind of started to happen now.
People are moving fixed deposits to equity markets.
There is also a tax element there, but that is very specific. But even at a pre-tax level, people are actually looking at this relative return business and they invest. Now, what happens is that here is a corporate, okay, which is seeing better demand. So their visibility on cash flows goes up. They are doing more capex, so their visibility on cash flows goes up even more. And then on top of that, that cash flow is being discounted at a lower rate because the rates have come down. So theoretically, you have a triple effect of actually stock prices going up.
So which are these sectors, if I had to ask?
So see, typically there are two things. One is which sectors will see a demand pickup because of interest rate cuts.
Yes.
So these are typically the long duration sort of assets or sectors. Where, So something like autos. Because wherever you are taking loan and doing consumption, right? So be it auto, be it
home automatically become favorable.
Right? Because you are
real
taking
estate,
long-term sort of loans.
Yes.
And if the interest rates come down, the EMI comes down. Right? So your propensity to go and buy autos and home will always get better as interest rates falls. Right? So those two are definitely the big beneficiary sectors. These are called as rate sensitive sectors. That's right.
Okay.
Then the third sector, typically NBFCs, because what they do is they tend to borrow from the market because they don't have the deposit franchise and they tend to lend to people. Now, what they lend to specialized segments and therefore the interest rate cuts out there to the borrower does not happen at the same pace at which the money that they are borrowing reduces when interest rate. So their NIMs, the spreads which they make, they tend to improve in a
NIM is net interest margin. The amount of money that I borrow from the thing
so
to
if
lend.
you are borrowing at 4% and kind of lending at 6%, 2%, very simplistically,
that is what they make.
Is the net income margin. Say. So NBFCs typically will see their NIMs expand when interest rates fall and vice versa when interest rates rise. But banks, on the other hand, have a reverse thing. That
Why?
when interest, because they are taking deposits also and they are taking assets also, and assets tend to get repriced faster than deposits. So,
but will deposit also go down?
FD rates will go down, but right now, say, there is anyway less liquidity with banks. They are looking for deposit. So deposit rate, they won't be able to cut.
Yeah.
But the borrowers, the rate they'll have to cut because otherwise they can go to NBFCs or they can go directly
Options
in the bond
come
market.
into the market, yes.
So for banks, typically the NIMs would contract a little bit with the interest rates falling. So it's a different impact for bank versus NBFCs.
Also, one more very interesting point which he's alluding to is the fact that actually the efficiency with which the new interest rate regimes have come about in the last 10 years has also meant that transmission is very quick. What I mean to say simplistically is that the RBI has stepped in to ensure that whenever there is a rate cycle, the transmission to the end borrower is quick.
Understood.
In fact, if you remember 10 years ago, if you had a home loan and rates are falling and you see it in the newspaper and nothing happens to your EMI. Okay. And it takes you like 6 months before it starts to move. That transmission effect is now pretty much
now we get an email and next month onwards it's instantly, it's up.
Next morning, this is the date on which it's applicable and this is how much it falls. So, the transmission mechanism in India, to give full credit to the RBI, has also improved significantly. But obviously, that has a slight negative lag effect on the banks. It was
very interesting because I didn't know that NBFCs will do well and banks might not do well, because usually you assume everything is a sector and everything.
Yeah, but it's the same.
But again,
it's just because one is borrowing from the market and other is borrowing from individuals.
Wow.
Yeah, but at the same point in time, like the point he was making about the consumption, year two, there is a play. What happens is that, as he rightly said, usually rates are coming down when there is a slowdown in the economy as well.
Yeah.
Now, if there's a slowdown in the economy, then NBFCs are also at the far end of the risk curve. What that means is that they tend to lend to the riskiest borrowers as compared to the banks, let's say. Which means that you also have to keep a very close eye on whom the NBFC is lending to, at what rates, and more importantly, whether that sector is going to get impacted by this or not.
So you deep dive into the loan book.
How sharp is the slowdown?
Yeah.
The point he's making is how sharp is the slowdown will ultimately kind of determine whether NBFCs get positively impacted or negative.
negatively.
If the slowdown is very sharp, then the NPAs, the probability of higher NPAs increases for NBFCs.
Okay. NPA is
Because they are
basically someone
typically-
doesn't give you the money back.
someone
Bad
doesn't
loans.
return the money back.
Yeah, because they are
Understood.
typically lending to slightly more riskier segment
Correct.
compared to banks. But if it is a soft lending, as they usually call, like, in economic terms, that there is a mild slowdown,
Yeah.
but it is not derailing your economy in a significant way, then NBFCs will benefit because the NPA spike, the bad loans will not increase significantly, but you will get the benefit of better spreads or NIMs.
Oh, this is
which we
very
talked
interesting. Very interesting. And what would be the bad sectors? What would get affected because of a rate cut?
So see, like just finishing on that part. So any sector where say a consumer or a utility where the top line will not get impacted because of slowdown, something like FMCG, very basic staples, you will not change your consumption if there is a 50 bips rate cut or a 50 bips rate
Correct.
hike.
That is true.
Right? So the cash flows are fairly steady. So discounting rate going down will increase their valuation. Similarly, utilities, the cash flows are fixed. Interest rates going down will increase their valuation and vice versa. On the other hand, if you look at certain other sectors, like, typically the cyclical sectors tend to do slightly worse. Again, because
okay.
When I say cyclical sectors, it could be, your anything economy, capital goods, and because falling interest rate implies that there is a slowdown in the economy.
That's why you're
And
boosting
cyclical
it.
sectors are highly prone to even minor shifts in demand patterns. But in case of India, like, because the interest rate cuts are not expected to be huge, because there is no slowdown right now being visible in the economy, then this may not apply. So again, you have to look at, country by country and, sector by sector. That is there a slowdown happening in this sector? So if the impact of slowdown in demand is more than the benefit that you get because of lower interest discount rate, then the valuations will get impacted negatively. But typically, cyclical sectors tend to do worse. And bank is one of the cyclical sectors.
Yeah.
Some of the other consumer discretionary, autos and real estate, they might not do well. So
Okay.
It's more cyclical, capital goods, infrastructure.
Just ask one last question now before we close this episode. Now, as a retail guy, what do I read or what resources do I use to understand all of these things? So I don't have a Bloomberg terminal. So how do I understand these things? In a simple format, like if you had to tell people, ye padho, wo padho, ye website mein ye dekho, what would you suggest? Maybe one or two each?
See, macro, I think The Economist covers it very well. I
Economist,
feel.
okay.
If you want to look at global macro leading up to the country level, of course, you can go into sectors there. I think they are the ones. Daily news, there are lots of different websites, including some of our own, but Yahoo Finance, and you can easily get the daily news over there. I think if you're keeping an eye on these two, at least for a global macro, you're fine.
You'll understand a lot.
Domestic, look, I am old school. I read the newspaper every day, like proper newspaper. Okay. But the two, so for regular press, I read the Indian Express so that you can keep an eye on what's happening politically. That matters as well, right? That's not something, we can build into everything, but sometimes it matters. There could be a state which could be going through turmoil and then you could have a company. So those types of things. And amongst the others, I think Money Control and Economic Times are the one that these three I follow like before I get to work every day.
Understood. So, what about you?
Like I would have a slightly different view, right? So, see, I think as a retail investor, because as institutional, it's our day in, day out work, right? That we have to analyze multiple things, including macro or news. But if I were a retail investor, I would be less bothered with the global, especially global news, global macro. Little bit of just staying on top by reading, say, I think Economist as a magazine I really like, just given the sheer content, not that it will tell you what's happening in the next 3 months or 6 months, but I think from your enhancing your knowledge base on what's happening around the world in different economies, it's a great magazine. So, but read it more from that perspective, not for active sort of investing or trading. And global macro for a retail investors is, I think, pointless beyond a point, because actually there are multiple other things. It's only one of a small factor, and the actually the value of that factor is diminishing, as I am saying. You know,
Correct.
with the domestics owning more and more part of the economy. What they should focus more on is local news, but again, news not from the. So again, one school of thought is the less newspaper you read, the better it is, because newspapers, if you read it, it basically reflects the sentiment.
So information overload is also
Information overload, more than information overload, it's a sentiment.
bias.
Suppose it is, you are reading it for last 1 year. What is the headline every day? Sensex is hitting a new high. You know,
Correct.
things are going through the roof. GDP is hitting all-time
DI
high.
inflow all-time
right?
high,
So you
yeah.
would read newspaper in the morning and you will come and get super excited and go and buy something.
Yeah.
Right? Without doing your homework. So it basically, to remove all biases, actually the less news, only factual news. Okay, what's happening on the GDP? What's happening on interest rates? What's happening is Indian economy getting stronger? So, say what is happening to our forex reserves? What is happening to our, fiscal deficit? What is happening to our... So those parameters are more important than the noise around or the sentiment around.
That is something I think retail guys don't focus at all.
Yeah. So typically retail guy would read the headlines. Okay, auto sales are at their highest. So you go ahead and buy auto, which is actually the worst time because they are at their highest or their peak, right?
Very
So headlines would typically be full of. Similarly, if you had read the headlines in COVID, it was all, doom, right? That things are coming to an end next month, right? So then you would have never invested. So I think sometimes it's good to be away from noise. Just cut down on the noise and just focus on certain important things that, okay, how are the basic economic parameters doing? Are they okay? Are they great? Are they good? Are they bad? Just basic, knowing the context that, okay, are we in a good economy, bad economy, is good enough for a retail investor. And then focus on your individual sector stocks on a more bottom-up basis. That is, in my view, a better way for a retail investor, because you have limited time, right? You're doing something else as well. For us, I would be spending 80% of my time or maybe 90% of my time on individual companies and sectors rather than trying to predict the news or the global macro or over-analyzing it. We just have an idea of what's happening out there, but the 90% of the time and the money and returns are made when you are looking at a sector or a company and how it's doing.
Understood.
Right? And not because, say Fed said something, so the company is not going to disappear because of that. But whether it will really impact it or is just noise, that is
And
what
how
you have
much
to...
will it impact?
Yeah.
Basically? Wow. Wonderful. Yeah. I think this was a lot of information today for people. And I also learned a lot today. Actually, I didn't know so many things. So I'm going to sync up with you offline for all of those things. Yeah. But I hope you guys enjoyed this episode. I hope you guys like this episode. And I want you guys to put in the comment section below as well. Put some comments on what questions you think you want more clarity on and what questions you might have after this podcast. We can start replying to them as well. Yeah. So again, thank you guys for staying for this entire episode. We will see you guys soon. Now, for all the people who love this podcast, I have something very interesting for you. If you are looking for a career in finance, then HDFC Sky is actually offering an internship program mainly for the people who are watching this video. Now, how do you apply? Very simple. Fill out the form that is in the description and also comment today about your take on this entire video. Now, I want you to put all your thought into this and do your research and fill out the form because I don't want you to miss out on such a beautiful opportunity of doing an internship in one of the biggest security companies in India. And also, what you get is crazy amount of knowledge. So don't miss out on this opportunity. We're giving it to you. So it's up to you now to take it.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.